Hello, Marco, and welcome to
Hello.
another episode of Not Your Money. Today, we'll be digging into staking and tapping into the wealth of your expertise. So let's dig right in. So, Marco, what is staking? Help us understand basic definitions. Let's start with that.
Yeah, so there's many different product out there that are called staking, but basically staking, if we go to the true nature of what it is the process of locking your asset in a technological provider called Validator, in the process of making it more secure, securizing a network and validating the transaction that exists in that network, and that network must be approved for stake network.
Okay. It sounds like a savings account in crypto. I know that's not the right answer. So help an average Joe looking at crypto for the first time, just making that basic
So
distinction.
true that you get rewards for doing that. Actually, all the actor in the validation process take a piece of the rewards of this process as well. But there is many difference. In this case, your funds are used by a technological actor, as I said, to perform a task. So you have counterparty risk, which are technological, the validator that you have chosen, and they're not necessarily just financial in that terms.
Yeah.
Plus, of course, like the value of that asset goes up and down. In a saving account, you are basically instead of doing a certain technological task, you're entrusting your bank with your money, hoping that they will make money out of that, and they will reward you for putting your
Okay.
trust in them.
So the similarity is you earn a return on your investment. The mechanics behind the scenes are completely different.
It's different.
Cool, great. Let's move on then. So we're talking of really proof of stake, which is the fundamental consensus mechanism behind certain blockchains, not all of them. Let's dig into that a bit. You've briefly explained that in your prior statement, but help us understand a little better how this
It
kind of circle.
basically has two status. Like a blockchain is a ledger, right? And a ledger has two status. It's the finalized status, in which if there is no transaction, is the final state of which a blockchain is. And the second one is whenever there are transactions happening, those transactions need to be validated. So you have proposed transaction, finalized transaction. As soon as they finalize, they go back into the ledger. While they're in transit, let's go like this, they need to be validated. They need to be make sure that this transaction can be executed effectively. It's like transporting from point A to point B, and then the technological actor, which is called the validator, with the asset that the user have delegated, can perform that job.
Perfect. So this is really important, right? It's about entrusting and making sure that the blockchain remains secure and that it remains intact, that its
Yeah, it's
information
like
is
any
needed.
ledger, right?
Mm.
Any ledger in a financial, or even your household, you have a ledger. Like, you need to make sure that if you pay something, you you
Yeah.
account everything, and that transaction or that payment has been executed properly.
Okay, perfect. We'll get into the actors a little bit later, but just before we do that, let's just jump into the actual mechanics. How does the staking work?
So there are two things. You have the technological actor called the validator, which is
Yeah.
basically a machine with a software, a specific software that runs, and your asset that are required to run one single node. One single node can actually perform the task we said before. Now, if everything is done properly, you receive a reward. Both of you receive a reward, and then those rewards are split according to some rules and regulation. If that job is not done properly, the machine broke, or something happened, like those funds were removed, even if it's not technically possible, but just for the sake of the discussion, then effectively that node cannot perform that job, and so it's slashed. It's a penalty that he incurs because he's not capable of performing the job that he's supposed to do.
And just to dig in a little bit on slashing, then does that mean the assets are at risk? Your
The
your
asset
investment is at risk.
it depends on every single blockchain has its own specific protocol and properties. So you can have, for example, slashing only of the rewards, so no rewards for the block if you're not doing your job. You can even put your principal, so the asset are at risk to a slash up to, depends, but yeah, most blockchains are up to 30% of the asset generated. So it really depends on each and single blockchain in which you are delegating your asset.
Okay, so again, as as a disclosure, we'll touch on some of the risks later, but in all investments come risks, and you just touch on variations to the theme depending on the various blockchains in terms of whether your rewards is at risk or whether the entire amount you put in staking can be at risk too.
Yes.
Great. So let's explore the yield. Where does that yield actually come from? How does that work?
This is important because you have to understand why it's sustainable. So on one side, you have a transaction that is generated, and that transaction it pays, like the user that initiated the transaction, the actor that initiated the transaction pays a fee for that, right? Now that fee is paying somebody to do a job, and that fees go split for the job of validating the transaction, for the validator technological actor, and the delegation asset delegator, which could be a single person. Okay. Now, of course, it's not one transaction, one node. The actual mapping is n transaction to one node. There is an algorithm that decides how to select how many for how much computational power needs to be used and so on. Once again, per specific technology, per specific blockchain, but that's how it works. So on one side, you burn, as the initiator of the transaction, burn a certain amount of tokens, and on the other, new tokens will be minted to rewards those who have performed the job. And almost in 99% of proof of stake today, you mint less or equal the amount that will be burned.
Okay, so the minting process what generates the new tokens in circulation, and that's what gets to a degree shared between the operator of the node, the validator, and the owner of the assets. That could be anyone that delegates that activity to a node. We'll explore.
Well, to a certain extent, if I with my bank, I send a transfer to your bank, like I pay a fee, and the bank is the one taking that fee, right? And it sent the money to you. Now, in this case, you do not have a direct transfer of money from me to the bank. In this case, is my fee will be burned, and new token will be minted to rewards these people in between me and you in the transfer.
Got it. Thank you. Okay, so who offers staking? Which chains offer staking? Just there's plenty out there. Maybe you can touch on some of the main ones, some of the main players. Where's a lot of the activity happening right now?
The main one, for sure, like by a big factor, is clearly Ethereum, and also because it's one of the first proof of stake protocol, and it's also the one that has the bulk of the DeFi, which generate a transaction as well. But it's where like this process has been perfected to a certain extent, and there is the highest volume of transaction on a daily basis for a proof of stake protocol, full proof of stake protocol. It's important to note that Ethereum wasn't born proof of stake. It was a proof of work before, similar to Bitcoin, and then it transitioned as a very popular transitioning that happened last year into proof of stake, and that has been massive as a technological leap.
Fantastic. So let's just get into the philosophy there then for a second. So what Ethereum has done and what other chains have followed through with is incentivizing holders to stake their assets, therefore lock in their assets for a period of time. That can be flexible depending on the different staking providers, right? That could be daily, quite liquid, or fixed for a longer period of time, and that way contribute towards the decentralization of the blockchains themselves, right? So it actually creates a participative economic system, if we like, in order
and I
to
think,
generate further yield.
it's a philosophical change to a certain extent, because we, in the fiat world, we do not participate. We are only users, but we are never stakers at any point. And stake means also like, shareholder. Let's put it like this: we are not a shareholder in this world. We do not decide how to print money. We have no impact on the money printing or tampering, if it happens, in the world. Here, that's the philosophical big change. Imagine if you can put your asset directly to the central bank and say, look, I have 100,000 euro, dollars, Swiss francs, whatever. I'm giving it to you, and you can use that as in a process in which, if you have to print more money, you can use my asset, and then you will reward me accordingly. So you will be participating in the same financial system that you end up using it. In the fiat world, it's not like that. We are only users, but we are not participating in the creation process. In a proof of stake, you are one and the other.
Perfect. Okay, so let's get into the actors then. What is a validator? What do they do?
Very, very, I'm oversimplifying here clearly, but a validator is a software that it's run on a technological instance, on a machine. Okay, and it's a specialized software, and its only job is to validate a transaction, which means resolving the mathematical algorithm behind the transaction system. A transaction means there is a new mathematical algorithm that needs to be solved in order to accept that Marco's account with X amount need to transfer a certain amount to Francesco's account. Everything is transformed into an equation, and that needs to be solved by software.
Yeah. Okay. Perfect. So that piece per se, the validating of data, transactions going through the blockchain, and the securing of the network to prevent fraud or double spending, is actually not that different in principle to blockchain mining, different consensus mechanism. It just works differently, right? So the fundamental activity in validation and securing the network is similar, it just operates in a very different way. One is using work, energy. That's what the mining does. Actually, in the previous slide, we were looking at all these various chains, and Bitcoin was not on that list because it works on a different consensus mechanism. Here, the activity through software and computer infrastructure, as you mentioned, is similar, but operated through a staking mechanism. You have to put your tokens in to contribute towards that security.
And it makes sense, right? Is you have a problem, like if you state from a high level point of view, if you state the problem, I have a problem, I have a transaction, and then you have solution, proof of something, proof of work, proof of stake. But you have to define the problem in the same way in order to have two different solutions that are only called proof of, and then that's the difference. But the problem is the same for both scenarios.
Great. So delegated versus non-delegated staking. Explain the differences. Sounds like from a simplistic mind, as my own, delegated is what the average person on the street would do. You don't operate infrastructure. You don't operate computers. You need technical expertise run that software. So the average person might not validate directly and will delegate that activity to a professional service. Did I get that right, or what am I missing?
I think the easiest way for non-tech people to understand is, you have in the office the clerks, somebody who does, repetitive work on behalf of somebody else, right? So imagine I need to have, a lot of invoices or things that need to be performed, like somebody needs to go to the post office and to take care of all these things. Okay, I give the money and say, go do that. Or I go myself. Now, if I'm the delegator, because I have to do something else, I just give you the money, and then you, Francesco, go to the post office and pay that invoice, or send a package or whatever needs to be done, right? And you are the validator, I am the delegator.
Perfect.
You perform the task. And
so you would agree that, you would agree that the vast majority, if not all of activity available through exchanges, be it Binance, Coinbase, you name it, where staking is available, is effectively a delegated staking. You're putting your tokens towards staking, but that will be performed behind the scenes by a validator, clearly not by yourself as the individual owner of the asset.
Okay, now if we put in centralized exchange, I think there is the complexities goes deeper. But let's say that if we want to oversimplify, I think we will go through this in the later slide. But, from a high level point of view, more or less, yes.
Okay. All right. So how do we select these validators? How do you go about it? What should we be looking for? What makes a good versus a bad validator? Aside from rewards, which might be one of the obvious elements to look for, you're always looking for that API, right? What is my return on investment? But I guess that comes with reputation, some other aspects to consider.
This is where, let's say, that's why many people, I would say that this is exactly the reason why many people go through a centralized exchange instead of going directly to publicly available validator to do this job, because you need to know, first of all, every single blockchain algorithm, proof of stake algorithm, how it works. In order to assess which is the best validator, you need to know how that proof of stake process works. And like we said before, every single blockchain has a different process. Globally makes the same thing, but how the details matter. And once you know that, then you start to understand how to do the due diligence of the validator, because you know that you need to maybe look at uptime, which is how much time is always constantly up that machine. You need to look at how much asset actually already have this validator has already deposited, and that, once again, depending on the algo, that's extremely important information. What has been the penalty amounts? That has been how many times this validator has been slashed. How reputable, like it means it is a person or it is a company that it runs maybe validators across multiple blockchain. How many fees are they taking for doing that job out of the global rewards? So there's many factor, and even there is no master formula.
And is this information widely available, Marco? Is it easy to go and fish around and find this information? How transparent?
It's publicly available. The problem is that this is, like I said, is a technological actor, and so it speaks a technological language. So, like I have a degree in software engineering. For me, it's not extremely difficult to understand how it works. But if you do not know how software operates, how the whole algorithm works in the mechanics, it may be difficult. So it makes sense to actually have somebody who simplify this for you, or to which you want to even delegate the job of selection.
So if you're not experienced, delegating, it sounds like the way. You're putting up some of your rewards, but you're entrusting a centralized player or a validator, or a professional service to go and hunt for the right provider for you.
Yes, yes. Unless you're, let's say, I can, one times rule could be the fees. Higher the fees usually means there is a more reputable institution behind the scene. It's not always the case. Double check if the validator is actually who is claiming to be. But if that's the case, if you have no idea how that system works, one safe
Great.
approach is look for a good one.
Okay, thanks, Marco. So you helped us understand how staking works. You've helped us understand blockchains allow us not just to expose our assets into a novel industry, novel assets, but also earn and participate by yielding that particular asset as we lock it up for a period of time, which is really interesting and innovative. So there's potential upside, but there are downsides too, right? There are risks involved. So I cannot not ask you the risk question. We've talked about slashing already. You've mentioned counterparty risk to a degree. Of course, the underlying token you're staking is subject to market and liquidity risk, as it would have been anyway, even without putting it at stake. What else should an investor consider?
I think, like, first of all, there is an important thing is understanding all the lockup, cool down, warm up periods to properly understand what your time window of investment would look like, and then that needs to be when you understand that, you understand, okay, is it the product that for me? Because if you want to have something extremely liquid that goes in and goes out, then maybe you're not talking about staking. If you're a long-term believer, or if you have a long-term strategy, at least of some months into a specific blockchain, then definitely makes sense. You need to understand, I would say, validator costs are more for due diligence of the validators. Counterparty risk, once again, the same, feel in the same category. I think that from users that comes from the beginning, looking at staking, I think the first question that they want to have to face themselves is, would I go with a centralized exchange, or should I go directly on the network? That's a big, very big question.
So if we think of a novice new investor, they typically by default start with a centralized exchange. That's where they'll make their first trade, their first investment. Say they buy Ethereum or Atom or whatever they like. They could start there, or as they get a little more experienced, when you say go onto the network, you mean going directly on staking providers. So moving their assets out of those exchanges and place them directly on the staking provider platforms.
I'm a big believer in DYOR. So, I'm trying to remove mediators as possible. But depends on how much time, of course, people have. But understanding, for example, if it is Ethereum today, there is so many options, good quality, and very viable option for staking, that I would not go to a centralized exchange. It's true that the more you go into new blockchains, then maybe start with a centralized exchange. But more mature blockchain, I think now we have very good process, very viable and easy way to access the information required and the knowledge required to actually do that. So I would suggest maybe it makes sense to participate directly.
Well, you're a sophisticated professional expert in this space. It all sounds logical. You're an engineer. You're an investor. I try and play around and experiment, but I suppose we still have a bit of a conundrum here, don't we? In a way, we're having access now to decentralized technology that enable us to participate, but whether or not that is really easy to understand and accessible to the masses is still a big question mark, right? I mean, is that really feasible that everyone does their own research? You mentioned, DYOR, do your own research, great. But with the average person on the street, with your neighbor, your family members, go off and shop around and deploy their capital, identifying staking providers in the way you explained. It's time, right? And time is money. Sometimes there's just the convenience of trusting a player in between, and therefore back to the sort of centralized players.
I agree. Just would put an asterisk there and say, well, be sure that, because staking is a very overused word. Not always, if you see a centralized exchange, the staking area, behind that is an actual staking process. It could be something else, which
Very
is
important, actually. Thanks for raising
closer to what actually happened with your money in the bank, in a traditional bank, rather than the actual proof of stake in a decentralized network.
So what you're saying is what might be presented as yield enhancement staking providers on a centralized exchange might actually not be actual staking, but rather delegating your tokens for further investments, for example, from that centralized exchange in an exchange of a possible return, but also an exchange of risk to that centralized player as well. And we're not talking of highly regulated players yet. We've seen plenty of issues with centralized players this far, and everyone should really look at this with caution and at the least understand what they're putting their money forward and in support of in generating extra yield.
Yes.
Great, Marco, thank you. So what about practical tips? How does anyone start? Where do they go? How do they get going?
Yeah, that's exactly what we're looking at, right? At the top, you have Binance, for example, and the bottom is the actual validator list from for Polygon. And basically, yes, in Binance, you can see that you have multiple products that are under the staking label, but not all of them that are listed here are actual staking. Actually, almost none. Most are delegation into other type of product that kind of can be called staking because of a closer effect that they're not effectively the participation in the proof of stake network of a specific blockchain. But yeah, they're very easy to use. They have a very simple setup and different depending on what type of product you get. On the other side, when you go, for example, the Polygon there, you have a list of names that if you're not very crypto native, maybe you do not necessarily understand some information that tells you nothing. And even the process of delegating, although today, like Polygon, for example, there is quite simple, to be honest, but it may not be super simple. You think that you have to move your asset in the right chain, or you have to be capable to understanding why one operator asking you 10% fees, another one 20, and what that means. So there are multiple aspects that needs to be understood in order to operate in the second side. So in the second page, to go directly at validator. But definitely, that's the staking that we are talking about. Everything that you do on an centralized exchange, there is quite a good chance that you are not effectively playing into the stake, the right direct proof of stake. And even if you do, you're going to pay an extra fee compared to going directly to the validator.
So let me play that back just to make sure that I get it right. So Binance, but it could be any other centralized player, may offer all sorts of different earning opportunities. They may not really be staking. They may have different lockups, different return yields, etc. You're entrusting that counterparty to work with your assets whichever way they choose to do in return of your yield. There may be some convenience in having it all in one place, if you like, but you have that counterparty exposure. And certainly you're putting more of your potential reward away, I suppose. You're leaving that on the table for the centralized player to use and take their own share. if you go a step further, we don't quite say it here, but I think, of course, you're suggesting you're a sovereign. You're working out your own wallets. You're connecting your tokens through your own wallets to staking providers. In this case, using the Polygon example, and then you're selecting your validator. You're probably more likely to get a higher return on your token because you're going direct. There are no intermediaries else than the validator who's operating that service for you, but you're truly participating in that staking activity.
Yes, but this is a choice that you make from the very beginning. If you're on a decentralized wallet, that's your money. If you go into a centralized exchange and you deposit the money there, it's their money that they are custody. They do custody for you. So
centralized players, not your money. Decentralized players, your money. Just a nice reminder. Okay. Tell us about the market today, Marco. How big is this space, and how is it growing? What are the trends? How do you see it evolve?
It's very big. It's very big. It's growing big. Has been growing for at least I would say 1 year and a half, 2 years since basically Ethereum moved into proof of stake. There are lots of products, and which we could actually start to call derivatives. So the staking market, I would say, primitive, have created the derivatives in crypto, and these are called liquid stake token. And this market is extremely important because it starts to making more advanced and more mature the crypto finance. We are following in the footsteps of TradFi that have created bonds, saving accounts, and then on top of that started to create more and more derivative products that are today 5 to 10 times bigger than the actual market on which they are based. In TradFi, in cryptos is not yet the case. Actually, we are a fraction of the global market, and it has to, because of what we said to the very beginning. In a proof of stake process, you can only mint tokens that are burned. I mean, you can over mint, but then usually it becomes an inflationary system. In the case of Ethereum, you are minting less than what you're burning, and that make a deflationary system. So in that case, for example, you cannot have a bigger market in staking that you have of the actual Ethereum. But we are in a above 20%, around 20% with the primitive of staking and derivative markets built on top of Ethereum. So 20% is how big that is compared to the basic market cap of Ethereum.
Sorry, just a follow-on question. You've mentioned this also at the outset. You've just reiterated it now around the inflationary profiles of minting and burning tokens on any given blockchain and network. That plays in presumably on the reward you have access to, right? The more inflationary a blockchain, the higher the minting on a blockchain, the higher the yield potentially. So that should be thought about with caution. You might have a higher yield, but maybe on a more inflationary asset, right?
Yes.
Okay.
Yes, that's kind of the game, right? Like in order to make it sustainable, the yield do not go crazy, because otherwise there is always basically there is an old saying in crypto. If you do not know where the yield comes from, well, you are the yield. And that means that if
there's no free lunch anyway,
exactly,
Marco, right? So if there's the higher the reward, the higher the potential. I don't say
if you're not capable to sustain, something in a complete closed system, then this money has to come from somewhere else, and that usually is new money flowing into the system, which is users.
Perfect. So I think the message there is tread carefully. Don't just chase the the higher rewards, that might be an indicator of risk that needs to be carefully examined and thought through. I should have also mentioned, actually, maybe this is not investment advice. Of course, we say that every time. It's not tax advice, but staking is often considered income. Depends on jurisdiction to jurisdiction, so keep that in mind as well. This is different to holding the underlying assets. Seek investment advice and tax advice around what each token means and how staking in particular plays a part in your investment portfolio. Okay, just before finishing off, we touched on some of the main assets, but do you want to just give us a quick overview of some of the key players? You mentioned ETH at the outset as the biggest player. What else is out there to watch?
One of the other biggest and oldest, it's the BSC chain, which is the Binance chain, which is in turn is very opposite to Ethereum to a certain extent, and is extremely centralized. There is only a fixed number of validators, and so you cannot have a very decentralized setup. There is Solana, who has a very different. Is not a necessarily proof of stake or only proof of stake. There is proof of history as well inside Solana. I think that all the others are trying to solve a specific need in the market. So there is competition. And competition, it's definitely good. So you expect to have a bloom of blockchain. That's why we have all of that. It's because we're trying to find a better blockchain, or even a blockchain per specific sector or needs in the market.
Thank you. And finally, let's just touch on some of the biggest players that are out there, some of the largest staking providers.
Yeah, you have multiple players. Here, the interesting part is actually behind Lido. There is actual player behind Lido, although is mentioned as a single provider. But definitely, you have big companies that are taking care of validators. And if you can do the parallel with Bitcoin here, is just as the miners are specific actors working in securing Bitcoin network and validating transaction. Those companies are specific companies that works only on validators, on making the validation process. So they maybe are not Lido, yes, but if I call a Kiln or Chorus One, Stratos, All Nodes, Lugan Nodes, like all those players are not necessarily well known to the retail user, right? Mm-hmm. They're just companies that work under the hood, and as very normal company, I would say they actually do have hardwares and farms out there, so they're not necessarily a crypto player.
Got it.
But a technological player.
Perfect. So what we see here on the screen is different providers in order of size, some information around their AUM. So these are some of the aspects you alluded to in terms of how we'd select from them. There's a rating here which indicates, I suppose, their security, their trust, their degree of success is in not getting slashed, but also the assets they support. So these professional services are either dedicated to one or various types of chains and getting more professional in that respect, operating across chains, right?
Yeah, correct. Like it's a way to trust, to select a validator, see how much IUM has, how much time, as I was telling before, how many times they actually been slashed before the past, how many nodes it runs, what asset it supports. So, but here we're talking technology. We're not talking anything else. It could be this could be a list of cloud providers, AWS, so Amazon, Google, Microsoft, and so on. So it's the same. It's very, very similar.
Maybe just final question on concentration. So there is a narrative in Bitcoin mining around the concentration of mining activities on a smaller than desired number of miners. Do we have much of the same in the proof of stake space? I know Lido is quite big
Yeah.
in the Ethereum landscape, for example.
There is this idea of the 51% attack risk. I think that we have two major forces, and not necessarily two forces that we can control. One is the decentralization effect generated by the algorithm or the process. Sorry, the process, the structure of proof of stake, it's by nature decentralized, so it promotes decentralization. But at the same time, is the professionalization of this actually generate more centralization. The more you are doing a certain job, the better you're getting at. So, and the more people trust you if you're doing it properly. So you become a centralized force into it. So you have these two energy two energy that are working as one against each other, right? In order to make the system successful, the global system successful. There may be some risk, to be honest, with this too much centralization. But at least I know personally, for example, the people at Lido, it's not like they're doing this to control it. It's more about providing the best service. And the more you are trusted and the more trust you generate. And that is important.
Sure.
So if you're working well, a certain level of aggregation, a certain level of concentration of funds end up being the result of it.
So if we just reflect on what that leaves us with, this promise of a decentralized financial network really enables us today to disconnect that need for a central player to manage all of our assets. Let's call that a bank today, where you typically go to access your exposure to bonds, to equities, to funds, and so forth. You can go directly and select your assets without having to pass through that centralized intermediary, so to speak. But you do end up having to operate and I suppose delegate or put your assets at stake with centralized players, ultimately in helping you deliver a return on your investment.
Yeah, and once again, it's I think that one of the important things is also to say that the system allows for this decentralization. It's not like decentralization is not allowed.
Mm-hmm.
Right? It exists, and as long as the system which is something that actually is in process, to reduce the entry barrier, to promote as much decentralization as possible, which is a very important factor. Future evolution of the Ethereum network actually are working on making it so that anyone with the smallest amount possible can participate into the staking network. Then I think that counterbalances the centralization effect that we have today with, for example, Lido and a few others. Because I can say that that's exactly what we end up not having in TradFi, just an extremely centralized system with extremely high entry barrier. To be a participant in the traditional financial system as a bank takes a huge amount of money, investment, connection, and so on to create a new bank. So it's centralized by nature, the system itself. In this case, the movement is actually of evolution is going in the opposite direction.
Yeah, we now have the tools to explore and invest on our own means. Of course, that goes back to the question of education, how the tools are there. It's up to us now to reap them and make them usable, digestible, consumable by the masses, and we'll see. I suppose it'll take some time to see how that plays out. Just like we used to rely on travel agents each time we went on a holiday, these days we're relying on tech,
ourselves.
on apps to book our travel ourselves and feel fully entrusted in that way. Same thing I think is happening here. So Marco, thanks so much for this today. I think we've really digested and covered the whole staking space quite well, understood what it is, how it works, who validators are, how we select them, what the market looks like, and I suppose in finishing, we now understand there is an opportunity on certain blockchains, on proof of stake blockchains, to put your assets forward, stake them for a period of time in pursuit of generating reward. That does come with risks, of course. So again, this is not investment advice. Do your own research, but perhaps be mindful of this opportunity. There's great opportunities out there. So explore carefully, and we hope you found this useful. Marco, any closing remarks just before we wrap up?
No, I think it's just, well, maybe one thing is like start considering staking as a potential strategy, maybe for your portfolio alongside with others, and start thinking that now you just don't have only trading, buying, and hopefully like what you're buying is rising in value. You may also have start thinking in a two-dimension system where you just have one dimension, which is buying and selling a token, and the second dimension is actually start generating passive income with that token through the delegation to a proof of stake provider.
Well said. Marco, thanks again. Let's close it here. And as always, follow us if you found this helpful, and we'll be at it again in the coming days and weeks for more content. Have a great weekend and see you out here.
See you. Cheers.
I hope you enjoyed our video. If you found the video informative, please don't forget to follow our channel and click the alarm button to be informed of new videos coming through. There is plenty to learn and get your head around on your journey to mastering crypto. Thanks for watching and see you on our next video.